Investing in a bear market, what you need to know right here, right now. Stay tuned. I'm Rob Tatro from robtatro.com, Senior Portfolio Manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. Today is going to be a fun one. We're talking about a bear market, what to do. We're going to take a look at macro stuff, big picture stuff, first things first. We're going to look at tips. We're going to look at strategies, what to do directly in your portfolio, what to do if you have cash. We're going to look at all of that. So thank you for tuning in. Take a sec to subscribe. Don't forget to like, follow, and share. We'd love to hear your thoughts as well on the video down low, what you've done in past bear markets or what you'd do in the next one. Also, as a reminder, if you'd like to book a no obligation consultation, please go to www.speaktorob.com. We'd love to book that for you to chat about this or anything else that is on your mind. All right, so first off, what's a bear market? A bear market is when a market corrects more than 20%. So a correction is a 10% move. A bear market is a minus 20% move, typically defined by the image of a bear. The bear and the bull, you've heard those terms in Wall Street before, and you've probably seen pictures of them. The bear is the bad one. The bull with the horns is the good one. So bear market, you're minus 20%. So first things first, big picture stuff. Let's talk about that. So periods of steep market decline, it's discouraging. It's emotionally difficult. You have a portfolio, you're down a ton. If you're invested in stocks, it hurts. It hurts right here. You're thinking you're never going to invest again. You're wondering why you didn't sell at the top. It was so obvious. I saw all the signs. Why didn't I do that? It's very, very difficult. First things first, keep calm. Remember to focus on the things you can control. You cannot control what's happened in the past. You cannot control what's happened in the stock market or what's happening. Think of today as a new moment, a new decision, a new era on a go-forward basis. So today the market's down 20%. It's discouraging. You're probably going to be depressed. You're going to be sad. You're going to be thinking, why did I do this? But remember, it's a buying opportunity, okay? So do not panic, all right? Warren Buffett always says, be fearful when others are greedy and be greedy when others are fearful. So when others are fearful, when you're fearful, when it hurts for yourself in the pit of your stomach, and when you're telling yourself, I'm never going to buy, or in fact, if you want to sell because you think it's going to get worse, that's typically a strong buy side. When no one's buying, that's the time you want to be buying. So start with that big picture, keep calm, carry on, and it's probably best to make a plan. So take a look at your situation first off. Are these registered or non-registered assets? If they're registered assets, there is no tax consequences for buying or selling. If it's a TFSA or an RSP or a LIRA or a RIF, you don't need to worry about tax loss harvesting. However, if it's a non-registered account or a corporate account, maybe it would make sense to crystallize some losses. If you have losses, to start taking a look at selling some stocks to crystallize losses on the books. Now, there's other videos that I've done about how to crystallize losses and the best way to do that. But remember, there are some rules in place here in order to crystallize the loss. You got to make sure you hold it for 30 days. You can't buy the same stock back right away. Remember, there are some rules for tax loss harvesting. You can't rebuy that same stock for 30 days if you want to crystallize the loss, and on and on. But maybe it's time to take some losses for tax purposes. If that's the case, maybe you jump into a similar stock or a similar sector for the next 30 days or so, and you could always go back to that stock that you really, really liked. Maybe if you own a bank, you sell it and you buy a different bank, and then you go buy back to that first bank. Now, you might not have losses because the market's been so strong, and you might have just gains on across the entire book. So if that's the case, forget about the tax planning. Let's take a look at the actual portfolio and what your plan is going to be. You should be thinking of making a plan, okay? So what does that plan look like? There's a couple different ways we can do it. First off, you can leg into the market. So legging into the market would be taking a chunk and saying every X percent that the market drops, I am putting this much capital to work. You could also say at this percentage or at this time period, I'm putting this capital to work. So this percentage every 1 or 2 or 3 or 4%, but you could also say every week or month or 2 months, I'm putting money to work. Now, when we're talking about putting money to work, two very important distinctions here. First off, are we talking about simply reallocating assets inside your portfolio? Or are we talking about new cash that exists elsewhere that you'll be bringing in to invest? So let's start with the new cash. Let's say you're sitting on cash, or maybe you're able to get a line of credit, or you've inherited money, or you sold a business, and it happens to be at a time when the market is in a bear market. So that would be a great opportunity. So now you have cash. First things first, you should make a plan for that cash. Take a look at what percent is this of your total assets. consider, is this going to be long-term investing? If it is, you should consider to invest all of it over a period of time. If it's going to be short-term investments, you need to consider and ask yourself, is this my only liquidity? And be very, very careful, because you do not want to put yourself in a position where you're using capital that you need for other purposes, buy a boat, buy a home, a down payment for something, or a purchase, a down payment on a trip or something, because you lose the liquidity, right? Once you put it into the market, you're kind of at the mercy of the market. If the market corrects another 10, 20% short term, maybe you lose that opportunity to do what you wanted with the cash. So if the money is to be invested long-term, you figure out how much you have, what percentage of it is of your total portfolio. If it's a small amount, like a 5 or 10 or 15%, I would suggest you just put it into the market. If you're in a bear market, 20%, put it into the market. Take a look at your holdings, which holdings have corrected more, which holdings do you need to top up, maybe add some sectors that you don't have, or maybe even just pick up some names that you currently don't have that have corrected a lot, and just add to your portfolio. The other thing you can do is just equally distribute among your current holdings. You probably have Canadian, US, and global equity. You probably want to divide it, I don't know if it's somewhat equally, but somewhat equally among those holdings. So you got $1 million portfolio, you got 100 grand of cash sitting on the sideline. There's a 20% correction. Put the entire 100 grand into the market now. Don't mess around too much with market timing. It's a really good buying opportunity. I know it's very difficult to do, but it's what's best. All right. Now, if we're talking about straight up asset allocation changes, so that means shifting one asset class to another, what you should be considering is a form of rebalancing. So your equities have dropped 20%. Maybe you need to be at 70 or 80% equities. You're no longer at that number. So that means you need to trim holdings from your other asset classes. That could be fixed income. That could be alternatives. It could be cash, commodities, whatever it may be. You trim those asset classes and you move it towards equities. If you want to be more aggressive, you could go at a higher end range of your asset allocation. So that might look like this. You had an 80-20 portfolio, 80% stocks, 20% alternatives, let's call it. And now there's a correction. So now your asset allocation is 75-25. So what you would do is you would trim that 5% of the alternatives, go to cash with that, and then you would buy stocks. That would be a form of rebalancing, or a form of taking advantage of the market correction, or I should say the bear market. The other thing you can do is say, you know what, I want to go 85% equities right now because of the bear market. Now, make sure you're also trimming on the way up, right? You got to be trimming your equities on the way up when it starts rallying. Now, this part's very important for you guys, that mentally, you're never going to get the bottom of a bear market perfect. You're never going to get it right. There's been a lot of bear markets in the history of the stock market. Sometimes they're 20%, sometimes they're 25, sometimes they're 30, sometimes they're 35. Depending on the situation that you're in, you never know where the true bottom will be. So it's very important for you to just make a plan ahead of time, focus on the information you have, follow that plan, and remove emotion from the process. So if your plan is to get half of your money invested at 20% correction, and the rest of it every percent or 2%, that's a great plan. And maybe you're all in at 30% correction. And if you don't hit a 30% correction, don't hate yourself for that. Focus on the things you can control and make sure the plan is well-founded. If it's a large portion of your investment, so you're talking about maybe, 50% of your investment. So maybe you have a $50,000 portfolio and you're able to scrounge up another $50,000. So this is now half of your investments are sitting in cash in a bear market. So my suggestion would be to consider putting a chunk of that in, whether it's half or a little bit more than half, and then you can leg in the rest of that over time, either over time or as the market corrects. Now let's talk about how stocks behave in bear markets. So typically your growth stocks, those are going to get hit a little more than the value stocks. The value stocks, they might outperform the broader index. If we get into the speculative stuff, the stuff that's trading at 100 times earnings or maybe 10 times sales, the kind of lesser known stocks or the meme stocks or the flavor of the day, those are going to get hammered, just so you know, because nobody wants to own those anymore. So you're going to get no bid, right? It's going to just drop. And it's going to be very, very, very difficult for you to stomach that. Defensive stocks are likely to do a little bit better. I would stay away from selling short if I were you, given that it's just an incredibly dangerous situation. So obviously you're not going to be panicking. You're going to be greedy when others are fearful. You're going to harvest tax losses if they exist. You're going to have faith in a recovery. You're also going to look for the signs and for an opportunity to put your money in. And if you're not sure, just make your plan ahead of time and stick to it. The one key thing here that I hope you gather and I hope you understand is that bear markets are once every 5 or 10 year opportunities for you to make a ton of money by either adding capital to your portfolio or to strictly rebalance and reallocate some assets to equities that have corrected a ton. It's going to be difficult for you to do so, but try to not miss the opportunity. All right, because it's going to happen. And big bear markets, like 30 or 35% bear markets, those are kind of once in a generation type opportunities. So you really got to make sure that you're able to pull the trigger. And if you can't, you probably should be working with a professional, a guy like me or another portfolio manager that can make those decisions and those moves for you. We did it in 2020. I went on BNN and I said equities are overvalued. I said it in January. We trimmed stocks right before COVID hit and we reallocated. And I emailed you guys right at the bottom and I told you on this channel, in this forum right here, I told you now is a generational time to be investing. Take that opportunity, put some money to work. I told you that on March 23rd, 2020. So we know how to do it. We put our money where our mouth is, and it's hard to do it. But the good thing is I'm agnostic to emotion and I'm agnostic to money. We make decisions based on logic and reasoning, and that's why our clients love us. So, hey, if you'd like to book a no obligation consultation, please go to www.speaktorob.com. We'd love to book that for you. I'm Rob Tatro, Senior Portfolio Manager at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. Thank you so much for tuning in. Don't forget to like and subscribe. Give us a share and a follow and give us your comments. We'd love to hear from you. Thanks for tuning in. I'll see you in the next video.